Morning, everybody. So we have the national accounts and the international accounts results here today for Q2 2025. We'll take questions in the after the session, and if you want to put them in the chat during it as you think of them, you're more than welcome to do that online. The material from today is on the CSO website, and the recording of today's session will go up on our YouTube channel. The important message with today's results is that we had very, very strong growth in Q1 2025, particularly with pharmaceutical exports, and we talked about those a lot in this room 3 months ago. The results today are showing us that while it doesn't have that high level of growth, that level has been sustained in the months of Q2 2025. So some really big half-year results there, and we'll focus quite a bit on the half year of 2025 compared to the same period in 2024 because of that. Those large M&E numbers. But behind that, there's also a really important domestic story with a lot of the domestic indicators, consumption and investment, up 2 to 3%, which in a European context is actually quite large as well. So we're trying to explain all those to you in the next 30 minutes or so. So I'll hand over to Ciarán and Lucia to take you through the national and international accounts.
Thanks, Chris. Good morning, everyone. I'll take us through our results for Q2 2025 in the national accounts. As Chris mentioned, I suppose the headline figure there is GDP up just 0.2% in the quarter, which is sustaining that level that we saw in Q1 of around 153.4 billion. When we look at the breakdown of this, we see it's really, we've seen continued growth in industry and information and communication, the two globalised sectors of the economy. A more mixed picture on the domestic side with growth in distribution, transport, hotels and restaurants and construction, but falls in professional admin and support services and finance and insurance activities. Looking at our modified domestic demand, our indicator of the domestic economy, it's up 0.6% in the quarter, driven really by growth in personal consumption of 1% and government expenditure of 2.5%. The investment figure is down 37%, but that's distorted by the lack of large IP imports that we had last quarter, which also affects our imports figure. But modified investment was down 2.1% in the quarter. Exports are down 4% quarter on quarter, but that's off a pretty large level and is still quite a large number underneath that. So I'll just go through some of the, I suppose, our other indicators that try to maybe describe what we've seen over the last quarter. When we look at our industrial production and turnover, June numbers, the production quarter on quarter seasonally adjustment, although the monthly picture is a bit volatile, that still we can see the 3 months of the quarter are still well above that level that we had in just recently as January. So those production levels have stayed up in the quarter. Looking at trade is again not at the levels we had in January, February or particular March, but April, May and then even June are still up on the same time last year, with up nearly 20% in the quarter on the same quarter of 2024. So it's that, I suppose really it's the pharmaceutical sector, the exports and the production that have kept us at that same level that we were in Q1. Looking now at the time series Q2 2025, we can see that we've had GDP number first, which driven by that strong growth in the globalised sector. We've seen 3 strong quarters and then a levelling out this quarter in GDP of the 0.2%. Modified domestic demand, the domestic side of things is up just 0.6%, but has been up positive for most, a lot less volatile than the GDP series and has been positive now for a number of quarters. This is our second estimate at Q2 2025. I think it's the end of July, we produced our T+30, our flash estimate, and we estimated at that time it was -1%. We've revised that now to 0.2% for today's T+60 release. I guess we've explained before that flash estimate is a frontier release, which means it's using new methodologies, new data sources to publish an early estimate of GDP, whereas today we've enhanced data sources, in particular more corporate information from those large companies that have a big impact on our accounts, as well as expenditure information, which allows us to produce not just the output method but an expenditure estimate of our GDP. Where this puts us on the European picture, we can see we're right on the EU 27 average this quarter, with the range being from minus 0.4% to 1.2%, with just Croatia, Romania and Denmark over 1% in growth in the quarter, and Finland, Germany and Italy under the line. Looking then at those sector growths that we've seen as the two globalised sectors of our economy, the industry and information and communication. We can see information and communication continue that steady growth we've seen now for a number of years, whereas industry has been growing quite significantly since Q1 2024, where after a number of years of falling, it's really the last year and a half we've seen significant growth there. And then looking at that, the time series, I suppose you can see that dark blue line, the foreign owned multinational dominated sectors. It's quite a volatile series, but it really mirrors that GDP picture of 3 strong quarters towards the Q3 24, Q4 24, Q1 25, with now a levelling off in Q2 2025. On the domestic side, it's a lot less volatile and tends to be more moderate growth. Looking more at those domestic sectors, we can see the two largest, distribution, hotels, transport and restaurant, and public admin and education, have really kind of, I suppose, slow, steady growth over the last couple of years, whereas a couple of the smaller domestic sectors, construction, professional admin and support services, construction has had an increase. It's quite a volatile series. You see lots of up and downs. I suppose it is a small sector. Relatively, but it's tracking, I suppose, the numbers the employment numbers we've seen from LFS recently. Professional admin and support services fell in the quarter again. Quite a volatile series compared with the two larger ones. Looking at wages or compensation of employees, with strong results this quarter, seasonally adjusted up 3.7%. That's really being driven by, you can see that those large employment sectors, public admin, education, health, distribution, hotel, transport, restaurant, increases there quarter on quarter. And this is a constant seasonally adjusted series, and the main driver here is a quarter on quarter increase in hours worked in the seasonally adjusted series. Now, looking at the expenditure side of our accounts, again, we can see the major net exports, that light green, and gross fixed capital formation, the volatility there among those, really due to that IP export or IP import in Q1 2025. I suppose the other point to note in this quarter is we didn't see in Q2 2025 that unwinding of stocks. You can just see it underneath the line in Q1 2025 that helped drive some of that export growth in Q1. Taking out those globalised elements, our net exports and our stocks and our globalised elements of GFCF, we can see that it's a lot less volatile picture of the modified domestic demand, and we see small growth in personal consumption and government expenditure with that small decrease in modified domestic demand. That's after taking out the impact of IP and aircraft leasing. Looking at that in more detail, you can see that it's the green, the modified GFCF, that is bringing down modified domestic demand slightly after growth in government and modified GFCF, personal consumption. Looking more at personal consumption, our estimate of spending in the economy, seasonally adjusted quarter on quarter, total is up 1%, with goods up 0.9% and services up 1%. I think that's been steadily growing for a number of years now. Looking on the European picture, it takes us slightly to the right of the picture, doing a bit better than a lot of Europe, with Croatia and Lithuania at the far right, and then just Finland and Netherlands on the far left. Government expenditure, I think it's important to mention it. It's a strong driver of that domestic investment in recent years. We can see, although we had a small drop in Q1 2025, it has grown steadily for the last number of years, and up 2.5% seasonally adjusted this quarter. Looking at it in more detail at that composition of capital formation, you can see the impact that yellow line of the intangibles has on the series. the results this quarter, we saw building and construction up 6.5%, driven really by strong dwellings result in the quarter. Machinery equipment down almost 20%, and intangibles down 15.4 billion. When we look to strip out the globalised elements of that, machinery equipment excluding aircraft leasing was up 1.5% in the quarter, and intangibles excluding R&D service, imports and trade and IP was still down 30% of the quarter, and that's really been driven by exports of R&D services and an increased quarter-on-quarter of exports of R&D services, which in our national accounts are capitalised and treated as a sale of assets, domestic R&D. That leads to our modified gross domestic fixed capital formation result, a drop of 2.1% this quarter. I'll quickly mention trends in net exports. I think Lucia will have more detail on it, but I suppose the main picture is that blue line, the dark blue, the exports of goods in Q1 and Q2, considerably higher than we've seen for quite a while. And with a small drop off in imports, we had a positive net exports this quarter, which leads us then onto our GDP, GNP and net factor flows or profit flows over the years. And we could see with a strong GNP result this quarter, driven really by that decrease in profits outflows from Q1 into Q2. But I think, again, Lucia will, I imagine, have more details, but that 60 billion in Q1 was quite exceptional historically, looking back, and Q2 was still very strong at almost 47 billion. Looking at prices in today's results on GDP, current prices is up 18.1%. GDP in current prices is up 18.1% year on year, and in constant prices up 17% year on year, which gives us an implied deflator of 0.9%. And on the consumption or spending, current prices is up 4.7% year on year, with constant prices up 3.2%, giving again an implied deflator of 1.4%. This Q2 gives us our first chance, I suppose, to start thinking about the full year picture and looking at those. So just take us through some of the half year results. GDP currently up very significantly at 18.5%, with modified domestic demand or domestic indicator up 3.8%, personal consumption up 3%, modified investment up 4.8%. The multinational dominated sectors are up 37.1%. This, of course, this is what's driving that GDP result, and is really seen we can see it in the exports of pharmaceuticals in particular in the first half of the year, which are up 40% year on year. The domestic sectors are up 1.5%, and compensation employees or wages up 1.4% in the first half of the year. So just to summarise today's results, GDP is up 0.2% in the quarter. On the output side, industry is up 2.5%, information and communication up 1.8%, construction up 6%, and distribution, transport, hotels and restaurants up 0.3%. The multinational dominated sectors are up 1.1% in the quarter, and domestic and the other sectors are down 0.1%. On the expenditure side, personal spending is up 1%, government spending is up 2.5%, investment is down 37%, but modified investment down 2.1%, and net exports are up 8.2 billion. Final domestic demand is down almost 16%, but modified domestic demand is up 0.6% in the quarter. And then looking at those net factor outflows of 47 billion this quarter, down from 60 billion in Q1 2025, giving us a GNP result of up almost 16% in the quarter, and compensation of employees is up 3.7% quarter on quarter, seasonally adjusted. Thanks. I'll pass it over to Lucia now.
Thank you. I'll now go through the international accounts for Q2 2025. We'll start with our infographic, which gives us a summary of the results for this quarter. We have goods exports of 95 billion and imports of 36 billion, which gives us a merchandise balance of 58.4 billion. We have services exports of 123 billion and imports of 111 billion, giving us a services balance of 12.4 billion. We have income inflows of 74 billion and income outflows of 125 billion, which gives us net income outflows of 51.4 billion. These combine to give us our current account balance of 19.5 billion, or 12.2% of GDP. At the end of June 2025, the net IIP, which is the balance between financial assets and liabilities with the rest of the world, stood at minus 338 billion, and their stock of foreign direct investment in Ireland stood at 1 trillion euros. We can see here our current account balance as a percentage of GDP. With no large IP imports or exports this quarter, the current account balance now stands at 19.5 billion, or 12.2% of GDP. Looking now at the current account in terms of year-on-year changes, we can see that the current account balance has decreased from 35.2 billion in Q2 2024 to 19.5 billion in Q2 2025, a decrease of 15.7 billion year-on-year. This is predominantly driven by different levels of IP imports and exports between the two quarters. Within this, the merchandise surplus is up from 38.6 billion in Q2 2024 to 58.4 billion in Q2 2025, an increase of 19.9 billion year-on-year. The services balance is down from 26.5 billion in Q2 2024 to 12.4 billion in Q2 2025, a decrease of 14.1 billion. The net income outflows have increased from 29.9 billion to 51.4 billion, an increase in net income outflows of 21.5 billion year-on-year. Looking at these figures in a little more detail, we can see that there was an increase in merchandise exports of 16.4 billion and a decrease in merchandise imports of 3.5 billion. This gives us an increase in net merchandise of 19.9 billion compared to the same quarter last year. There was a decrease in services exports of 8.7 billion and an increase in services imports of 5.4 billion, giving us a decrease in net services of 14.1 billion, compared to the same quarter last year. There was a decrease in primary income inflows of 7.1 billion and an increase in outflows of 14.3 billion, resulting in an increase of 18.3 billion in net primary income outflows. Within this, direct investment income was the main driver of the change in both inflows and outflows. Direct investment income inflows have decreased by 3.9 billion, and direct investment income outflows, which are mostly M&E profits, have increased by 18.8 billion. Looking at the current account balance over time, we can see that compared to last quarter, our merchandise balance is down by 15.8 billion, our services balance is up by 12.8 billion, and the net income outflows have decreased by 16.6 billion. This results in a current account balance which is up 13.7 billion quarter on quarter. This quarter on quarter increase in the current account balance is mainly driven by no significant IP activity this quarter. Looking specifically at goods imports and exports, we can see that our Q2 goods exports are down compared to last quarter and up compared to last year, while our Q2 goods imports are down both quarter on quarter and year on year. So the changes in the net merchandise balance are mainly driven by developments in the goods exports. Looking at the breakdown of bought merchandise, we can see that the increase in net exports year on year is largely driven by a combination of growth in the international trade and goods for processing exports, while the decrease in net exports quarter on quarter is driven by international trade. So to give more detail, our international trade exports are down 25.2 billion on last quarter and up 9 billion on last year. Our goods for processing exports are up 8.7 billion quarter on quarter and up 4.5 billion year on year. And our merchanting is up 0.4 billion compared to last quarter and up 4.2 billion compared to last year. On the import side, our international trade imports are down 1.7 billion quarter on quarter and up 0.5 billion year on year, while our goods for processing imports are down 1.9 billion quarter on quarter and down 4.1 billion year on year. Next, looking at the services exports compared to the same quarter last year, we have an overall decrease of 8.7 billion. This is broken down into an increase in computer services of 8.1 billion and a decrease in business services of 18 billion, which is largely driven by different levels of IP exports between the two quarters. Within business services, we also see an increase in operational leasing exports of 127 million. Tourism services are down 196 million, while transport services are up 550 million. Turning to the import side, we can see that year on year we have an overall increase of 5.4 billion. Within this, business services have decreased by 187 million, with R&D decreasing by 164 million. Royalties have increased by 5 billion, and tourism services are down 243 million on the same quarter last year. So the increase in imports is largely driven by increased royalties. Looking at these royalties a bit more closely, the blue line gives us the total royalty imports, while the green bar gives us the amount of royalty imports related to the pharmaceutical sector. Most of the difference is related to the ICT sector, which is captured as part of the other in yellow. For pharma, we can see a quarter-on-quarter increase of 0.3 billion and a year-on-year increase of 0.7 billion. Overall, we can see a quarter-on-quarter increase of 2.7 billion and a year-on-year increase of 5 billion. So therefore, increases in royalty imports both quarter-on-quarter and year-on-year are driven by increases in ICT royalty imports. Turning to direct investment income, we have inflows of 16.6 billion and outflows, mainly M&E profits, of 66.1 billion, resulting in net direct investment income outflows this quarter of 49.5 billion. Year-on-year, inflows are down 3.9 billion, where outflows are up 18.8 billion, giving us an increase in net direct investment income outflows of 22.7 billion compared to last year. Looking at quarter-on-quarter changes, inflows are down 4.3 billion and outflows have decreased by 19.6 billion. These combine to give us a decrease in net direct investment income outflows of 15.3 billion compared to last quarter. Focusing on the breakdown of direct investment income outflows, we can see that our income on debt is fairly flat as usual, but an increase in dividends and a decrease in reinvested earnings when combined give us an overall increase in outflows year on year and a decrease in outflows when compared to the previous quarter. The increase in dividends seen this quarter relates to increased production in previous quarters, as well as also including a seasonal component of dividend payments. Next, looking at the breakdown of quarterly profit outflows by sector, we can see that the change this quarter is mainly driven by the manufacturing sector. Compared to last quarter, there's a decrease in the manufacturing sector of 17.9 billion, while the information and communication sector remained quite flat, with a small increase of 28 million. Compared to last year, we have an increase in the manufacturing sector of 18.8 billion and an increase in the information and communication sector of 1.8 billion. Looking at the financial account, we see large net transactions across most functional categories. In direct investment, we have transactions in direct investment abroad of 4.8 billion and transactions in direct investment in Ireland of minus 34 billion, mainly related to the distribution of profits that were actually accrued over previous quarters. This gives us net transactions in direct investment of 38.8 billion. Meanwhile, in portfolio investment, we have net transactions of 42.1 billion, and in other investment, we have net transactions of minus 60.4 billion. The net transactions in portfolio investment and in other investment are mainly related to the investment fund sector. Next, we turn to the international investment position. The IIP is the stock of assets and liabilities that Irish residents hold in or owe to other countries. The difference between the assets and liabilities is the net IIP and represents either a net claim, if positive, or a net liability, if negative, to the rest of the world. Just to note that the navy bar visible here represents direct investment, while reserve assets are barely visible on the graph. The net IAP stood at minus 338.1 billion at the end of June 2025, which is an increase of 59.7 billion on the end of March 2025. This increase is driven by changes in non-financial corporations. Within this, the net position in direct investment stood at 132 billion. The net stock of portfolio investment stood at minus 797 billion. The net other investment stood at 316 billion, and the stock of reserve assets was 11 billion. So, following our publication in July, we've also included this quarter the IAP breakdown into foreign and domestic control to further showcase the large level of multinational activity of foreign control corporations in Ireland. The foreign-owned net IAP stood at minus 524 billion at the end of June 2025, while the Irish-owned net IAP stood at 186 billion. There are further breakdowns by institutional sector and functional categories in the publication. Turning now to the accounts with the US, we will first have a look at the trade income and current account. The merchandise balance with the US is up 12.1 billion year on year to 27.4 billion in Q2 2024. Compared to the previous quarter, the Q2 merchandise balance with the US is down 23.3 billion. Meanwhile, the services balance with the US has decreased by 5.3 billion compared to last year, and increased by 9 billion compared to last quarter, giving us a services deficit in Q2 of 43.4 billion. Net income outflows have increased by 8.2 billion compared with Q2 2024 and have decreased by 4.3 billion compared to Q1 2025. So therefore, we have a positive merchandise balance, which is offset by negative services balance and negative net income, resulting in a current account deficit of 34.8 billion in Q2 2025. This reflects an increase of 1.5 billion from the deficit of 33.3 billion in Q2 2024, and an increase of 9.9 billion from the deficit of 24.8 billion in the previous quarter. We'll now turn to the net IAP vis-a-vis the US, where, like in the US current account, we are looking at the geography of the next counterpart. We can see positions in net direct investment in navy, net portfolio investment in green, and net other investment in yellow. At the end of Q2 2025, Ireland's net international investment position vis-a-vis the US stood at 1.2 trillion, up 221 billion from the previous quarter. The increase was mainly driven by changes in net direct investment, where corporate restructuring led to changes in the next counterpart geography of assets. To summarize, we have a current account balance in Q2 2025 of 19.5 billion, or 12.2% of GDP. Our merchandise exports are down compared to last quarter, but still up compared to last year. We have decreased business services exports and increased computer services exports and increased royalty imports compared to last year, and increases in income outflows compared to last year. And lastly, the current account balance with the US stood at minus 34.8 billion in Q2 2025. I'll hand you back to Chris.
Thanks, Chair. So there's a lot of new information there for you today, I guess, particularly around some of the new stuff around the US in the international accounts. And over the next couple of weeks, we have a lot of publications coming out. You'll see that feed off this information, particularly on productivity, some stuff around hours worked, on government spending, household saving. You see the differences in the consumption and wages as numbers there. But today, I guess, the big picture, the new information is the quarter-on-quarter change, so that the M&E activity is sustained at that high level that we saw the growth into in quarter one, sustained in Q2. But fairly healthy domestic growth there across a range of indicators. So we stood back and looked at the first half of the year, 2025, to give you some sort of an indication of kind of where we're going with the two. A little bit of caution about the big numbers. You know, when the full year pans out, they may come back a little bit. But strong M&E growth now in the first half of the year compared to 2024. As Kieran said to you, the growth really started in Q3, Q4, Q1, and now it's continuing into Q2. So when we see the full year, we may have slightly lower M&E growth. So a little bit of caution on that, but it's very strong growth. But then for the rest of the data, looking at the domestic economy, personal consumption up 3% for the first half of the year over last year. Modified domestic demand 3.8%. That's a fairly healthy domestic economy there too. So we'll open it up to questions. I'll start in the room and then go online to give people a bit of a chance to type them out if they want to online. Anybody want to start off in the room?